This tax course is now more important than ever before.
Say in the last 3 or 4 years, there's an increase in landlords who are just not making any money. They get a lot of grief, they pay a lot of time and want to sell the property.
So I spent an entire day with an accountant to see if there's a way of massively reducing the amount of tax you pay despite all these changes, and luckily there is.
First year I did the tax return, he had about 6k of income tax to pay on the rental income. I mentioned the form. In the subsequent year, they had no tax to pay.
So in this course, we will cover all the recent tax changes, break down every single tax which applies to property investing, and give you strategies on how to minimize that tax. But let's start with the recent tax changes. What have been some of the biggest changes in property tax in the last few years?
When the tax base of the country is so low, it's something that governments continuously change and adjust. It's slow to sell a property, but it's quicker to raise tax on that. Properties are easy pickings and it's easy PR points for government to target landlords, people with second homes. People haven't realised the change in some of the rules around tax for landlords. I think it's because the rules are constantly changing and people don't always have the time to keep on top of that. The biggest change has been around the deduction that you can get for mortgage interest on the property that you rent out. Previously, you used to be able to claim the whole of your mortgage interest as an allowable deduction. If you've got 10 grand of rent and 5 grand of mortgage interest, then you're only paying tax on the 5 grand of profit. Since then, there's been a change in that, so now you only get a tax credit for the mortgage interest equivalent to 20%. It's bringing people up into the higher rate, an additional rate of income tax. So people are paying a large amount of tax, it's just less lucrative now.
Any other big changes in property taxation in the recent years?
I think the other big one is around stamp duty. You will used as a tool by successive governments to boost economic growth, to kind of deter certain transactions. And we've seen that change within a tax year multiple times for the last few tax years. And as came out in the October 2024 budget, for people who are buying second properties or people who are buying a property for a limited company, there's now an additional 5% to pay, where this was 3% of stamp duty.
What do you see as the impact of stamp duty going up?
Firstly, it's an easy tax, isn't it? It's an easy way to collect money. But I suppose it's there to deter people buying second houses and allow people who don't have a property to buy a house. But there's also the cynical thing that it's an easy tax on people. And then I suppose the other one is around furnished holiday lets.
These are your Airbnb properties.
Like short-term lets that are, but yeah, that's to be scrapped from 25-26, and that was quite a very lucrative scheme for a lot of people who had those kind of properties. So previously, if you had a property that was defined as a furnished holiday let, you could claim the mortgage interest as the entirety of it as a deduction.
So basically it was the same as buy-to-let properties pre-2016, whereby you could just say, well, actually, all of my mortgage interest is a cost, and then just deduct the whole thing.
Exactly. Yeah.
But now I think what you're saying is that it's the same as the current buy-to-let laws, which is whatever your interest is, you can only deduct, is it 20%?
20%, yeah.
Because I guess for a lot of people, what they would have done is they would have switched their properties to Airbnb rentals in order to just get rid of that extra taxation. And even if they made slightly less money renting in an Airbnb, by the time you looked at your tax figures, you would probably still be slightly better off, even if you made less money on paper because your taxation was so much lower.
Yeah. And other benefits they had were people, if you owned a finished holiday let, you could claim capital allowances. If they own a property and have that kind of capital expenditure, they'll only see the benefit of that in their tax when they sell the property, whereas people with a finished holiday let could take an in-year deduction for those.
What exactly is capital allowances?
So capital allowances, it's for the purchase of equipment, stuff like dishwashers, big kind of plant and machinery, but also stuff that enhances a property's value. So if you get a new kitchen, if you're a standard buy-to-let landlord, that's not an allowable deduction for you in year. But if you are claiming capital allowances, that's capital expenditure, and you can claim that as a deduction. It's for those kind of big purchases that enhance the value of the property, and the ability to write that off as an expense via a capital allowance was allowable to those with a furnished holiday let. And I suppose the final benefit of a furnished holiday let was that when you sell it, you were able to claim business asset disposal relief, which meant that when you sold your property for capital gains tax, you'd be able to claim the relief where you only pay 10% capital gains tax on that. Obviously, with the finished holiday lets going, that kind of availability will not be there after the 24-25 tax year. And also with the changes in the October 24 budget, business asset disposal relief is also changing.
What do you think has been the biggest reason behind these regulatory changes?
Across the political spectrum, there is a general acceptance that the shortage of housing and the shortage of people being able to buy a house is the source of a lot of the problems with the economy. So I suppose a lot of changes are there to try and provoke that kind of increased house availability, trying to increase the housing supply, not only for people to buy, but also people to rent. I suppose as well, there's been a general move leftwards in governments since probably like 2016, where there is more call for people who have the resources to kind of pay higher tax, and it's not as acceptable to own multiple assets in a way that perhaps it was in the 80s. There's like a move in the political spectrum, but there's also trying to provoke a higher amount of housing supply for people to buy and rent within the country.
I do think it's a bit of a catch-22 at the same time, because there's a lot of smaller developers, but by continuously increasing stamp duty, it makes it less viable for small developers to actually start building. So on one side, there's a lack of supply of properties, but at the same time, if you're a small developer, it makes it also challenging to develop.
I suppose landlords are easy to kick, but also like landlords provide a service that local authorities and housing associations are not providing enough of. You're kind of damned if you do, damned if you don't, if you're a landlord.
In the 60s and the 70s, I think, the data shows that most of the properties were built by housing associations and the councils, whereas in recent years, all of the properties are built by private developers. The councils do not build any properties whatsoever anymore. Do you have this situation whereby if you're a developer, generally seen as a bad thing to some degree, but at the same time, only the private developers actually build properties in this country, and so if everyone stopped building, the issue would be significantly worse than what it is currently, in my personal opinion. I mean, every government says we're going to hit the target of 300,000 houses every single year, but the government isn't building those houses, nor are the councils. It's the Bellway homes and the Barrett homes and small developers and large developers and everyone else. For some reason, it's still seen as a negative thing, being a developer as opposed to a positive thing, though they're the only ones who are actually building the properties in the first place. Which tax changes do you see potentially coming in the future when it comes to property taxation?
I think it's going to be mainly around capital gains tax. As you've seen with the budget in October 2024, basic capital gains tax rates are increasing. Residential properties, capital gains tax increased, I think it was a couple of years ago. That's an easy way to tax people, and it's good PR for government. I think capital gains will be where they kind of target landlords and people with buy-to-let properties. I think stamp duty is definitely liable for change as well. They've increased the surcharge to 5%. In the October 24 budget. That's clearly on the agenda. From a political point of view, it's probably hard to argue against that. They'll probably change stamp duty for foreign landlords, foreign owners, people through a company. There's that kind of increased targeting of stamp duty, I would imagine.
Because of all these tax changes, whether it's stamp duty, whether it's mortgage interest relief, from a taxation point of view, and what have you seen in terms of the changes, in terms of the money people actually make, the incomes in their pockets, once all taxation and everything else is accounted for? How do you think that has changed in the last few years?
It's definitely decreasing. I think I have few conversations with people who own properties where they're pleased with how much money they've made that year and how much tax they've had to pay compared to probably a few years ago. The profitability is definitely decreasing.
What's your general advice in terms of, well, how do you get back to the profitability people once had in the world of property investing? What are some of the things they can do to essentially keep adjusting to the changes?
I think it's all about being proactive, like stop being reactive. If you are assessing your tax situation after the tax year has ended, you've lost any controls you have over changing how much tax you've got to pay or how much profit you've made. But if you're having those discussions, either with your accountant or with a financial advisor, about being proactive, looking forward at rule changes, looking at what you can claim, looking at kind of where the money is going in and out of your property business, I think that's the best thing you can do. And those clients I have where we have ongoing discussions, they're the ones who get the best returns.
Is it possible if someone had the right tax advice, they could be just as profitable as they once were before?
I think so. If you are aware of what you may be paying, if you're aware of kind of what costs you have, you can fluctuate your rental income, hopefully, to reflect that. But I think it's having that forward-looking kind of mindset makes a significant difference.
Now, the final thing I wanted to get onto in this section is the need for personal advice. Everything we say in this property tax course, to some degree, is one size fits all, and in reality, nothing is quite one size fits all. We're saying that maybe someone should set up a limited company as opposed to buy a property in their personal name because, well, this tax has changed, or that tax has changed, or mortgage interest relief has changed. But for someone watching this, maybe in their particular situation, it might be better for them to be buying properties in the personal name because your income is below a certain threshold. It might actually be a bad thing for them to buy properties in a limited company because they're not getting impacted by mortgage interest relief as much as someone who's a higher rate tax earner. I just want to get across that this is a foundational level information, which is a one-size-fits-all approach. But how important would you say is the need for personalized advice when it comes to property taxation?
I think it's really significant. Everyone's situations are different, everyone's earnings are different. If you get that tax advice that's personal to you, you'll get such better outcomes from that. If, as an accountant, if I know your personal situation, I can give you better advice than giving you generic advice from gov.uk. There's that personal approach makes a significant difference to that.
If you would like personalized tax advice from John or one of his colleagues at TaxScouts, click the link in the description below and get started. TaxScouts can give you that tailored advice. They have amazing reviews and Trustpilot, and they can even help you with your self-assessment tax returns. Right now, new users can get 10% off. So if you would like to start working with an accountant and work out an accounting strategy which can help you save as much tax as possible, click the link in the description, speak to an accountant, and get started.
Now let's go through all of the different property taxes that we have in the UK. So the first one I guess we have is the income tax.
Everyone is aware of income tax, we all end up paying it. Your rental profits are subject to income tax, and those are added to your other income you have, whether that's employment, self-employment, investment income. And income tax is then taxed at the marginal rate of 20%, 40%, 45%.
Let's say someone is making £50,000 a year as their salary from their profession. And so then they say, I now have a buy-to-let property and I'm making £1,000 per year or £2,000 per year when it's all said and done. Because you were making £50,000 from your salary and now you're making additional £2,000. That £2,000 pushes you in the next tax bracket. You will not be paying 20% tax on your rental income in that case. You would be paying 40% tax because it's pushed you into the next tax bracket. And I think there might be some misconception that I'm a 20% taxpayer and this is additional income and therefore I'll pay 20%. But I think that's probably one of the most important things to consider of how the income from your property pushes you into the next tax bracket. And again, that's where professional tax advice comes in, because then you might have to start considering, well, actually, if I'm already a high rate taxpayer, is getting the money, pay myself through an income the best way? Or could I pay myself through a dividend and therefore pay lower taxation? Could I have a company and therefore claim some expenses and lower my taxation, and so therefore I have lower income, and so on and so forth?
I think it's worthwhile as well, especially like if you're at that basic rate, high rate kind of threshold. If you've got the ability to utilise, for example, your spouse's personal allowances, your spouse's kind of arrangements, if when you're on that kind of line, that's when you want to be having a discussion really, because there's options available to you.
Then we get on to capital gains tax.
So capital gains tax is when you sell an asset. Everyone who sells a property is subject to capital gains tax. Most people get relief because they live in that house. But if you have a second property, you'll be paying capital gains tax when you sell a second property, 18% if you're a basic rate taxpayer and 24% if you're above that.
The capital gains tax, does that change whether you own a property in a limited company?
So a limited company won't pay capital gains tax. If you own a property in a company, you'll pay corporation tax on the sale of a property. So corporation tax is currently 19% if your profits are below 50k, or 25% if it's over 250k, and it kind of tapers in between. So the kind of the disposal rates on tax are slightly, but more like kind of less in line with the capital gains rate.
So then we have the stamp duty land tax.
When you purchase a property, you'll pay stamp duty equivalent to the value of the property. If you own a second property or you buy a property for a limited company, you'll pay a 5% surcharge on that. There are reliefs for first-time buyers up to a certain value, and the stamp duty is up in terms of how the value is. You don't just pay one rate on the whole amount. It kind of is split into the values of the property.
Okay, so then we get on to inheritance tax.
When you die, your estate, they will accumulate the values of all of your assets, including any properties you own. And then depending on the value of your estate, inheritance tax will be paid on that. It's not paid by you as an individual, because obviously you're dead. But then the people inheriting the properties won't pay the tax either. It's your estate, when you die, pays tax on the value.
So then we get on to tax residency and domicile. What are the tax differences when it comes to residents of this country and non-residents? So, for example, let's say someone lives in Singapore, India, Hong Kong, they live somewhere abroad, and they're looking to invest in UK properties. Do they get treated in the same way?
There's two main things to consider if you're a non-resident. So firstly, even if you're not a resident in the UK and you're a tax resident elsewhere, you will still need to pay UK tax on your UK income. Depending where you are resident or where you are domiciled, that depends on whether you get a tax-free personal allowance or not. That varies between countries. So that's something to be mindful of. Not everyone will get a tax-free personal allowance. The second one is that if you are a non-resident landlord, so you are not a UK tax resident, but you have UK property that you rent out, you have to sign up for the non-resident landlord scheme. This is directly with HMRC through a letting agent. A letting agent would deduct tax from your rent before they pass it on to you, and they send this directly to HMRC. If you are not renting it through a letting agency, the tenant has to deduct that tax and send that directly to HMRC. So it's something to be mindful of.
And when you say deduct that tax, are you referring to income tax or any other kind of taxes?
Yes, income tax.
And at what rate would that get deducted? Because of course they don't have income in the UK, so which tax rate would they fall into?
So it's a good question. HMRC just gives you a figure to deduct.
Right.
So they don't give any clear guidance on that.
Right.
But once you register with HMRC, they'll tell you what to deduct. But generally, it's the basic rate. It's generally that.
So then we get onto the property ownership structures. So these are the different ways of owning a property within the UK. First, the most common one, which is the individual ownership. You essentially save up some money, you go and buy a buy-to-let property in your own personal name, and so you therefore yourself are the owner. That is the most basic thing, is what I think most people have been doing over the longest period of time, over the last few decades. How does joint ownership work?
When you jointly own a property with someone, whether it's a spouse, friend, unmarried partner, that has an implication on how you declare that income. If you are a spouse and you jointly own a property, you have to declare that 50-50 unless you get a declaration of trust in place, which allows you to split that rental income in a different percentage. If you're an unmarried couple and you own a property together, you can declare that rental income however you like. If you have a furnished hold let, whether you're married or not married, you can declare that in whatever percentage you want. So your legal relationship between you and the other person you're buying the property with can have an impact on how much tax you pay and how much income you declare.
So let's say you have a scenario whereby there's two married people and one has a job and one doesn't have a job. Now, from a taxation point of view, it would make more sense that they receive the bulk of the income from their property, purely because they're not paying any tax, and they might even fit into the personal allowance limit of £12,000 per year, which is completely tax-free. But in which scenario are you able to say, well, actually this person gets all of the rental income even though we both jointly own that property?
That would be a legal arrangement you'd have to make between yourselves via a declaration of trust. It can be a really beneficial thing to do. It sounds quite grand, but like it is, like from quotes I've seen from solicitors, you can get it for about 200 quid.
Okay.
So you go for your solicitor, they will create the declaration of trust, and that allows you to split the rental income however you like between spouses. And then once you do that, you file that with something that's excitingly called Form 17 with HMRC. Once HMRC agrees to that, you can then declare that rental income however you like. It can have such a big difference on people's tax, especially where one partner's working and one isn't.
I think as part of this course, I think most people would want to know what are some of the best ways you can save property tax. And this is one of the biggest ways people aren't aware that you can actually save so much money with property taxation rather than selling your property just because you think, well, actually, this is no longer going to work. Just by paying £200 to a solicitor and signing Form 17, you can be in a situation whereby you actually might be even more profitable than before.
So I've got one client where he's an additional rate taxpayer, so paying 45% income tax, and his wife doesn't work, she just looks after the kids. The first year I did the tax return, he had about 6k of income tax to pay on the rental income. I mentioned the Form 17 declaration of trust, and the subsequent year they had no tax to pay because it was all declared in her name, which is legally able to be done via this process. It can have a significant impact not only on your tax, but like the cash that you've got.
Let's say you have a rental income per year of £10,000 and your mortgage interest is about £5,000 every single year. So normally what would happen is, in that situation, you've made £5,000 profit, but from a tax point of view, you can only deduct 20% of your interest, which is, £1,000 in this case. So you haven't made £5,000 profit, you've actually made £9,000 profit from a taxation point of view. If you're then a higher rate taxpayer paying 45% tax, well, you have to pay 45% on the £9,000, which comes to £4,050 in tax. If we think about it, we made £10,000, £5,000 was a mortgage, £4,050 is now the taxation. So you're basically left with around £950 in terms of profit. But if that same property was now in your spouse's, not spouse's name, but the spouse got all of the income from that property, what would happen is you still have rental income of £10,000, you still have £5,000 in terms of your mortgage. You can still only claim £1,000 in terms of your mortgage interest relief. But on that £9,000, which is your taxable income, if your spouse doesn't have an income, you have a £12,500 taxable allowance. So on your first £12,500, you don't pay any tax in this country. If the spouse is now making £9,000 in terms of income, well, there is no tax to be paid whatsoever on that property at all.
Exactly.
So you have a scenario whereby, in one case, you have your spouse is paying £4,050 in tax, compared to literally paying nothing in tax because you paid £200 to a solicitor and signed Form 17. In this case, would both the partners have to co-own the property, or could one own the property but the income could be passed on to someone else?
So you can get a declaration of trust that does that. That sends the income, but the income is going in someone else's name who doesn't own the property. Whilst that's allowable, it's open to scrutiny from HMRC when you come to trying to get the Form 17 signed. It might look like anti-avoidance, so I would deviate away from that if you can.
So in an ideal world, try to own the property together,
Exactly,
as
yeah.
opposed to doing it that way.
Yeah, or at least have someone who is directly in the family. You give that income to a child or, brother, sister.
Okay, then the next way of owning a property is limited companies. Now, this has, of course, become so much more popular since 2016 because of Section 24 changes, which we'll get into a lot later on in terms of why it might be better for certain people to own a property in a limited company as opposed to a personal name, because of the way that is taxed and because of the way you can claim certain expenses and you have tax deductible expenses and so on and so forth. Anything else you want to add to the limited companies?
I think the key one, just from a tax perspective, is that if you buy a property through a limited company, you'll pay an extra 5% stamp duty when you purchase the property.
The other consideration, I think, would be that, generally speaking, properties bought on a limited company, they have slightly higher interest rates.
Yeah,
compared to owning a property in your personal name. I think there is a narrative nowadays that people have to buy a property in a limited company and that is the only way. But there are some downsides for some people.
One thing I'd add on that is, as well as that, I've seen a lot of people who buy a property through a limited company, they then have to become personal guarantors for the mortgage, even though it's in the company's name. And if you don't have the best kind of personal credit score, you can sometimes not get that mortgage. So I think it's very personal whether you go for a limited company or not.
Okay, so now let's talk about the taxes you pay when you buy the property in the first place. So the main tax you pay when you buy a property in this country is the stamp duty land tax. What are some of the recent changes to stamp duty which have just come into play?
The most recent one is the 5% surcharge on top of standard stamp duty rates for people who are buying a second property or buying through a limited company. The other kind of changes around first-time buyers, I think they get up to £425,000 purchase with no stamp duty. But the stamp duty tend to change in year as governments seem to raise tax and target the tax base of the country. They do tend to fluctuate, but they do aim their kind of reliefs at first-time buyers and also aim their penalties and surcharges at those who are looking to buy a second property.
So yeah, this change obviously came into play literally as of a couple of days ago with the October 2024 budget, where for additional properties, the surcharge used to be 3%. If you bought a second property, rather than paying the normal stamp duty rate as a first-time buyer, you'd pay 3% additional on top.
Yep.
But now that's gone from 3% additional to another 2% on top, so now it's gone to 5% additional on top.
There's also a surcharge for if you are a non-UK tax resident, so that's 2% on top of current stamp duty rates as well.
So what is the stamp duty rate if you're buying a property as a first-time buyer and you don't currently own any other properties?
So if you're a first-time buyer, if it's up to 425k, it's 0%. Between 425 and 625, it's 5%. And if you buy a property for the first time and it's over 625, you will then revert to standard rate stamp duty. So standard rate stamp duty it's 0% up to 250, 5% up to 925, 10% then up to 1.5 million, and 12% over 1.5 million.
And let's say you are buying a property as a buy-to-let property, investment property, and this is your additional property. Now, some people might be in a situation whereby they're buying their buy-to-let property as their first property. They might not own a home. So in that situation, I believe you pay the same rate as a first-time buyer, unless you're in a limited company.
Yes, if you go for a limited company, you'll pay the standard rates plus the 5% surcharge.
This is one of those scenarios whereby if you are buying a property for the first time, it might not necessarily be more beneficial for you to buy in a limited company, because you will still, even if it's your first property, you will still pay the additional rate. Whereas if you bought a very expensive property in your personal name, you will have a huge saving in terms of stamp duty. So if you're buying a property, whether it's in a limited company or if it's your second property, what are the stamp duty rates in that case?
If you buy an additional property or through a limited company, it's the standard rates of 0% up to 250, 5% up to 925, and 10% up to 1.5, and 12% up to 1.5 million, and then add 5% on all of those. So there's no 0% stamp duty for a second property. The basic rate of that is 5%. So as you say, like you're buying a first time property at 425, you can pay nothing. Whereas if you buy it through a limited company, you're going to pay a significant amount more in stamp duty.
When it comes to stamp duty, are there any reliefs or any exemptions which people can claim?
The main relief is around first-time buyers. There are reliefs available for where you are buying multiple properties, multiple residents at once, for example, like HMOs, properties that are connected.
The other thing I would add to that as well, that if you're buying a commercial property, the tax rates are slightly different when it comes to residential. So generally for commercial property, the stamp duty rates are lower. And the other thing is, now this is not necessarily a taxation point of view, but I recently worked with someone whereby they bought a property which was inhabitable. Now there are some conditions in which a property becomes inhabitable. If a property has damp, if it doesn't have a kitchen, doesn't have a bathroom, there's an entire list of criteria which can deem it inhabitable. And in that scenario, you can claim a relief on stamp duty and you can get the additional rate back, because essentially you're buying a property which is not habitable. So that is one way you can get a relief, but you would have to buy a property which is not habitable. You can't buy something and then make it inhabitable and then, essentially claim the relief. But there are some rationale there. But the main one, like you said, is a first-time buyer, or the fact that if you buy a property which is a commercial property where the tax bands are much lower, I think they're almost half compared to residential property. When it comes to the income tax on rental income, how exactly is that rental income tax calculated?
Your rental income is added to your other income, so like employment income, self-employment income, investment income, and then you are taxed at the marginal rate that you are paying tax at. So everyone starts off with a personal allowance of £12,570, and then you pay 20% income tax up to £50,270. After that, you pay 40% income tax up to £125,140, and after that, it's 45%. Your personal allowance will taper down to nil after 100k of earnings. But yeah, your rental income is taxed alongside your income from other sources.
Okay, so that is how much tax you pay on your income. But the most important thing, especially because of changes in taxation in recent years, is how that income is calculated in the first place. We touched upon this earlier, that if you're making £10,000 a year rental income and £5,000 of that is your cost, well, your income is only £5,000. But from a taxation point of view, if you own that property in a limited company, your income is not £5,000. Your income is significantly higher than that. So let's say you own this property in your personal name and you're doing your tax returns at the end of the year. What are some of the expenses you can claim in order to reduce the amount of tax you pay?
So HMRC use the phrase wholly and exclusively relating to your property income. Common examples of this: any repairs and maintenance, anything that's maintaining the quality of the property, not enhancing the quality. You've then got like your letting agent fees, legal fees, accountancy fees, so always a reason to go with an accountant. You got your mortgage interest, which comes in as a tax credit. If you pay for the utilities on behalf of a tenant, then those are also allowable deductions for income.
Are there any deductions which are not that common and people sometimes miss potentially, which people can claim and they're not aware of?
I would say that some people think that mortgage interest is no longer playing into their tax calculation. Just because the rules in how mortgage interest as a deduction have changed, some people assume that means you don't factor that in anywhere. So I think the key one is that even though it's less lucrative than it once was, in terms of the deduction, there is still a deduction to be made there.
In that case, there might be people thinking, well, actually, I can no longer claim any of my mortgage interest as a cost.
Yeah.
But that's not necessarily the case. 20% of your mortgage interest you can still claim as a cost, which could be a sizable amount for a lot of people.
And I suppose if you don't use all of that mortgage interest as part of your tax credit, that rolls forward. Even if you don't get the whole benefit of the mortgage, the interest you've paid that year, you will get that in future periods. So it's worth continuing to factor in.
You mentioned that something which upkeeps the property. So for example, let's say you put in a brand new kitchen. Is that something you can claim or something you can't claim?
You can't claim that. because that's enhancing the value of the property if you're doing it correctly. If you have to replace carpets or you need to replace a door because someone's kicked it in, that's just maintaining the value, so you can claim that year on year. But if there's something like a new kitchen, a new bathroom, a pool in the garden for a tenant, like those are going to increase the value of the property, and therefore you would factor those in when you sell the property.
So that would essentially come into play with your capital gains tax as opposed to your rental income tax. Are there any hidden ways of saving some tax when it comes to upgrading kitchens or bathrooms? I mean, are there any justifications which people can make? You're not necessarily upgrading the property, but the condition of the kitchen or the condition of the bathroom has gotten so bad, maybe there was a leak. By putting a new kitchen, could you make any arguments that is still maintaining, or will that just be disregarded because, well, it's a brand new kitchen?
If you put in a like-for-like kitchen that's not enhancing the value, then there's probably an argument to make there. If you've got a leak, then you need to fix that leak in order to be able to rent it out, at which point that would be a deduction. Another one that I think people sometimes forget about is around windows, new windows. Generally the rule is you've got to replace like for like, but for houses with old kind of single pane windows, the government kind of accepts that people aren't replacing single pane windows with new single pane windows. So if you do have the expense of double glazing, that is generally an expense that's allowable against your income tax.
So of course these expenses and deductions are based on if you own the property in your personal name. Now let's say you own that property in a limited company and you were changing a kitchen, you were changing a bathroom, how exactly would that work?
If you bought a new kitchen through a company, you would have two options. As the board of directors, you get to decide what the accounting policies are. You could either capitalise it onto the balance sheet and claim a capital allowance, which would go against your corporation tax, or you could just take it to the P&L, the income statement, and again reduce your profit for corporation tax. Both of those would have the same impact on your tax. It would just be a case of how.
So then we get onto one of the biggest things when it comes to income tax, which is a mortgage interest relief. So in 2016, new laws came in with Section 24 that you can no longer claim your entire mortgage as a cost. You can only claim 20% of your mortgage interest as a cost. So I think there might be some confusion there as well, because if you have a property and you're on a repayment mortgage, it's not 20% of your entire mortgage, it's 20% of the interest portion of that mortgage. Whereas if you have a buy-to-let property, and normally most people have that property on an interest-only mortgage, it essentially means 20% of your entire mortgage because the entire thing is interest only. So now as a result of that, a lot of people are now in a situation whereby their taxes have significantly shot up, because even though the amount of money they get in their pockets at the end of the month is exactly the same, from a taxation point of view, their income or their profit is no longer the same because of the fact that you can't claim your mortgage as a cost. So that is a change when it comes to mortgage interest relief. Now, what are some of the ways people can get over that relief and save a bunch of tax there?
Whilst there have been changes since 2016 around what mortgage interest is allowable for an individual when paying their income tax, for a company this has remained as a fully allowable deduction for corporation tax. So the entirety of the mortgage interest is an allowable expense if the property is held within a limited company.
So for example, if you have a property whereby your rental income is £10,000 and your mortgage interest is £5,000, you can, in a limited company, claim the entire thing as a cost, whereas obviously if it's in your personal name, then you can only claim 20% of that. So then we get onto furnished versus unfurnished properties. Are there any tax implications of providing property furnishing? So for example, let's say you have a rental property and you provide the tables and the sofas and the beds and everything else. Does that come into play from a taxation point of view?
So I think there's a couple of things to kind of mention there. If the property is furnished and empty, you'll still be liable for council tax. If it's unfurnished and empty, then you can claim relief from council tax for that. It's not a significant amount, but that is something. And then in 1617, the wear and tear allowance, that was removed, and instead the replacement relief came in. So previously you could claim an allowance equivalent to a percentage of your overall rental income to cover the wear and tear of products within the property that you rent out. Now you can claim replacement relief, which is where you have to replace something like for like, and you can claim that amount as a deduction. The new item you purchase has to be equivalent in standard and quality to the previous one it is replacing. If you buy something that is an enhanced version, you can only claim the value of the equivalent of the old item that has been replaced.
And does that apply to furnishings, or does that apply to anything within the properties?
So it applies to movable furniture, soft furnishings like carpets and curtains, household appliances and kitchenware like crockery.
So before you had a situation whereby, let's say you made £1,000 a month rental income, maybe you can just deduct 5% as a cost because, well, that was your wear and tear allowance, because eventually at some point you would have to replace those things. Whereas now I guess that's changed to only as of when you actually replace that thing, you can then claim, well, I've actually had to spend £100 or £200 for something which is like for like, if I'm correct.
Yes. And I think in practice it has worked out to be probably a bit more generous. I think I've seen from like tax returns, it does seem a bit more generous now than just the 5%.
So you think people are saving more tax by the fact that the government has actually made those changes?
It seems like it's worked out that way, whether they intended it to do that. But I think if you buy a dishwasher or something, that probably works out more than 5% of your rental income for a lot of landlords. So I think it has worked out.
So unintentionally, the government has actually done something good for landlords.
Yeah. So you've got to cling on to any positive, really. But that's one unintended positive there.
Now, one of the big things when it comes to rental income is the rent-a-room relief. How exactly does that work, and what is the criteria if you want to get some relief there on your rental income?
Rent-a-room relief is for where you are either a guest house, B&B, or you live in the property with your tenants, and you have to provide a room that has sufficient furniture for such person to live in. And if you meet those criteria, you can claim £7,500 a year of income tax-free. And if it's £7,500 or less that you have in income, you don't need to declare that to HMRC. If you earn over that, you can either claim the £7,500 or you can take actual expenses if that worked out to be more tax advantageous. If you live in the property with a spouse, partner, whatever, and you jointly own that property, then you can share that relief between you both. You don't get £7,500 each.
Let's say I've got a property and I've got a spare room in my property which I then rent out, and I'm making £7,500 rental income. Now, on that £7,500, because that is tax-free, if I then declare that as income, do I then still have to pay my normal income tax, or is that completely tax-free from all sort of taxation?
So the 7.5 would be tax-free, and you don't need to declare that. It would only declare it if you were over the 7,500.
So it's not a case of, well, there's no property tax to pay, but then you end up paying income tax or some other sort of taxation on top.
Yeah, it's just completely non-declarable, non-taxable.
So that's probably one of the best ways of making money from property completely tax-free that there is.
Yeah, definitely. Especially in places like London, or where you've got a spare room. You do see, like on Airbnb, a lot of retirees who have kids who've flown the nest and they rent out that room. It's free. It's free income essentially.
When it comes to the eligibility criteria, one, is there any criteria? And second, if you have, let's say, a room which is more like an annex in your house, is that something which you can still claim as a room, or is that considered a separate property, even though with an annex, so it's a small annex in your back garden which has electricity and utilities and everything else? Could that be considered a room, or is that considered a buy-to-let property and therefore the normal rules would apply?
It depends how you enter the annex. There's rules around if the annex has a separate entrance to the property, then it's generally not allowable for the rent-a-room scheme. But if you have an annex, say like a garage that's attached to the property that you've converted into accommodation, because they have to come into the house to go into their property, that would be allowable for the rent-a-room scheme.
So what if an annex was joined onto a house, but it had its own entrance and you can enter from the house? Or is that like a grey area in the middle?
Yeah, it starts getting complicated at that point. But it is kind of all about the entrance. Has it got its own facilities? If you're providing an annex that's then got bathroom, kitchen, that's not really a room in itself then. That's starting to become a bit more than just a spare room. It's aimed at people who've got spare rooms to let that out, as opposed to whole serviced accommodation.
Yeah, so really, if you want to make £7,500 tax-free every single year, you need to get the front entrance of the house right.
Yeah.
That's what
It's a really big thing here. Where the front door is has such a big impact on the tax.
With all of this advice, like I said, this is one size fits all. If you want to work out exactly how much tax you'd have to pay in your situation, one of the things you can use is you can use a TaxScouts or rental income tax calculator. So then we get into capital gains tax. This is probably one of the biggest taxes people have to pay in the world of property. What exactly is capital gains tax, and when does that apply?
Capital gains tax is where you sell an asset that's deemed to have enhanced in value, and that's the tax you pay on that disposal. So it's separate to income tax, but is declarable within your self-assessment tax return. Capital gains tax for basic rate payer, it's 18%. If you're a higher rate or additional, it's 24%. So when you pay capital gains tax, you pay that on the profit on disposal of the asset, that being your costs, your proceeds less your costs.
Now, with capital gains tax, you do actually have a relief. So you have the principal private residence relief. What exactly is that, and what is the criteria in order to claim relief on any capital gains in that situation?
Yeah. So technically, everyone who sells their house pays capital gains tax. It's just that 90% of us are able to claim this relief. So this relief is for when you have lived in the property. So the periods where you have lived in the property, those are exempt from capital gains tax. So if it's been your home, your only home, but you've lived in it your whole time, there's no capital gains to pay there. If you have rented it out, you get relief for the periods you've lived in the property, as well as the last 9 months of ownership.
So if we have an example whereby, let's say you bought a property to actually live in yourself, and you lived in that property for, let's say, 5 years, you then decided to move elsewhere, you rented that property out, now it's been rented out for 5 years, and now you decide to sell it. How exactly would capital gains tax come into play in that scenario?
So for the 5 years you rented it out, you would pay tax on that proportion of ownership. So if you've owned it for 10 years and you've rented it out for 5, you'd pay capital gains tax on 50% of the disposal. The calculation gets a bit more complicated though, because things around the last 9 months of ownership for everyone, you're always deemed to have owned it. So that would factor in as well and would reduce that capital gains tax.
Let's say someone has an investment property and the last 9 months is owned and is rented out. Are the last 9 months some sort of relief, or how does that work?
It's just the last 9 months of ownership are deemed to be the period you've lived in it as well, whether you have or not. So if you've owned it for 5 years, then rented it out for the final 5, you'd only pay tax on the 4 years and 3 months, essentially, of the period of ownership.
In that scenario, or in any scenario, even if you've owned a property for a few years, how exactly do you deduct the last 9 months? Do you say, well, actually, the property was only worth 200,000, and now in the last 9 months it's gone up to 250,000? Or what exactly does that actually mean in terms of taxation in numbers this last 9 months?
So this is where you need an accountant, really. You have a calculation where total sale proceeds, then you have your costs that would be deducted, and then you would apportion that across the whole period of ownership. So you wouldn't segment it.
So you would just give an average across the 10 years
exactly,
that you've owned it, and you say, well, actually, take the last 9 months off, take off the first 5 years because that's when I lived in it, and therefore, if you made £100,000 gain, divide that by 10 years, that's £10,000 every single year, and then knock off the last 9 months, knock off the first 5 years, and you essentially end up with your gain, on which you'd pay the 18% as a basic taxpayer and 24% as the additional taxpayer.
Yeah, you would take it as an average as opposed to, say, the values shot up in the last year. Unfortunately, we can't really factor that into the calculation.
Are there any other reliefs when it comes to capital gains tax?
Yeah, so if you buy a property that's uninhabitable and you can't move into it straight away, you can claim private residence relief for that first 2 years of ownership as long as you move in afterwards. So that empty period there, that won't go against you because obviously you're renovating a property. If you are disabled or in long-term residential care, then the last 36 months of ownership, even if you've not lived in the property, will be tax-free.
So when it comes to capital gains tax, so you pay this tax when you sell the property. Of course, you have a lot of expenses. You might have renovated the property, you might have furnished the property. How exactly do you calculate what that gain is? To give an example, I recently sold a property in Brixton. We sold that property for £400,000. I bought that property for £240,000 a few years ago. So with that example, how would the capital gains tax work in terms of what I can or can't claim?
So you deduct the cost of the property from that. You deduct the buying and selling costs, that being like estate agent fees, legal fees.
And then any finance fees, valuation fees?
Yes, so all those, essentially anything that's on the completion statement when you sell your property is deductible other than the mortgage redemption. And then you've also got your costs where you've enhanced the value. So if you have done like a new kitchen or a pool in the garden, or you've created an extension, those capital costs are then deductible at that point when working out your profit. And then everyone also has, like you have your personal allowance of income tax, everyone then has an annual allowance for capital gains tax, which is currently £3,000 a year, which isn't as good as it was, but it's something to reduce the tax further. When
it comes to capital gains tax, are there any allowances which you can claim or any deductions you can claim which a lot of people aren't aware of? Or is it simply a case of, well, you knock off the refurb and the purchase price and the legal fees and you're done?
Whilst they are quite like vanilla in terms of like buying and selling costs, I think people always forget they can claim those.
Right.
I think people generally think it's the property purchase cost and the property sale and they think it's just one deducted from the other. But actually, you've got all your buying and selling costs, capital costs, and I think people aren't always aware of those.
So when it comes to the capital gains tax, when exactly do you end up paying the capital gains tax?
So it's changed since 2021. You now have to report any sale of property within 30 days of the completion date. There's a capital gains tax return service with HMRC that you have to register for, and you have 30 days from completion to report the profit, report the sale, and either pay any tax that's available at that point. If you also do self-assessment, you then would report that sale within the self-assessment at the end of the tax year and reconcile the two. So it is an added bit of bureaucracy there.
And are there any penalties that if you were to have a late filing or anything along those lines?
Yes, so there are fines and penalties, and I think it's worth flagging as well that the land registry, where you do your stamp duty, you sell properties, they report information day to day to HMRC about property sales. So HMRC will find this out and they will contact you, and they're very kind of, this is something that you can't just ignore. They will do that. And if you miss the deadline, the 30-day deadline, there's a flat £100 penalty. If you're 3 months late, there's a daily penalty of £10. If you are 6 months late, you then get a penalty of 5% of the tax due, or £300 if it's greater. If it's up to 12 months, it's a further 5% of the tax due. And if you've not done it within 12 months, it starts to look in HMRC's eyes like tax evasion, and they can open a whole tax investigation into you. So it can get serious quite quickly, especially if you're dealing with big profits on the sale of your property.
So when it comes to capital gains tax, this is one of the ways you can avoid it completely and essentially pay zero capital gains tax. So to give you an example of my property in Brixton, I bought this property a few years ago for £240,000. Now, when you buy a property, I put down 20% as a deposit, and then the 75% of that came from a mortgage. So 75% of £240,000 is £180,000. That is essentially my mortgaged amount. Now, I then had to pay stamp duty, which was £9,500. I had a refurb cost, which was £26,230. I then had to pay for furniture, £3,020. Legal fees, which came to £4,520. And then finance fees. I bought this property on bridging finance, which is essentially short-term finance, and that came to £10,543. If you add up all that cost, that comes to £293,813. Once that project was finished, that property was then revalued by the bank at £320,000. So essentially, I've spent £293,000. It's revalued at £320,000. So that means I've made a profit of around £27,000. Now, in this scenario, normally if you were to then sell that property, you would then be subject to capital gains tax, and that is what you would pay. Now, rather than selling that property, what I at that stage did was I then refinanced that property. So I then went to a new bank. They valued the property at £320,000, and they gave me an 80% loan to value mortgage, which comes to £256,000. So imagine the second bank has given you £256,000 as a mortgage. You still have to pay off your first mortgage, which was £180,000. So now once that £256,000 has come in and you have paid off the first bank their £180,000, well, now you're left with £76,000. That £76,000 comes into your bank account, well, either within your limited company or within your personal bank account, depending on if you bought that property in a limited company or as a personal entity. But that money is now not subject to any sort of tax, because that money is essentially a loan from a bank rather than income or any sort of capital gains. So rather than selling the property, if you then refinance that property by getting a new mortgage on that property, you are not liable to any sort of taxation. Whereas if I sold that property, I would pay capital gains tax on the £27,000 profit. As long as you keep refinancing the property, you avoid capital gains completely. And then if you wait, let's say 5 years, 10 years, and the property values continue to go up, if you then refinance that property again, once the value has gone up even further, well, once again, you will not have to pay any capital gains tax, because, well, all of that money is essentially a loan as opposed to income or as opposed to capital gains. So that is something you could do to avoid capital gains completely, as long as you're willing to hold the property for the long run as opposed to sell that property off. So then we get on to holiday lets and short-term rentals. How exactly does the taxation work when it comes to holiday rentals? So these are your guest houses, your Airbnb properties. What does the tax look like there?
These would have fallen under the Furnished holiday let regime, which is ending as at the end of 24-25. But these are properties which obviously are furnished, based in the UK or the European Economic Area, which is the EU, plus Liechtenstein, Iceland and Norway. And these have to be commercially let with the intention of renting it out. So they have to be available for 210 days and actually let for 105 days. And an individual cannot stay within that property for more than 31 days, otherwise it would discount the furnished holiday letting regime. So if your property met those criteria to be a furnished holiday let, you were able to claim mortgage interest as a full allowable deduction. If you sold it, you'd pay a lower rate of capital gains tax, but unfortunately that regime is ending as at the end of 24-25 tax year, and people who own those properties will be taxed as if they were a buy-to-let landlord with the same kind of regime and expenses such as that are allowable.
For people watching this, and if they have a Airbnb property or a guest house, do they now just fall into the same camp as buy-to-let, or is there any still differences between buy-to-lets and furnished holiday lets?
They'll fall under the same kind of regime as buy-to-lets. I think it's really noticeable the last few months how many clients have come to me who are looking to sell their furnished holiday let, not only because it's no longer profitable for them from an income tax basis, but also like if they're looking to sell that in the future, they're going to be subject to higher capital gains tax. So it's really stark on that. And I think especially as this tax year ends and we prepare those tax returns next year, it's going to be really noticeable, the amount of people selling those properties.
So when it comes to capital allowances, before you could claim capital allowances, and now it's gone to, well, now it's exactly the same as buy-to-let and you can't claim capital allowances, or how does that work?
Exactly, yes. So previously, if you had purchased some plant and machinery or equipment for your property, you would have been able to claim those as capital allowances and thus a deduction from your income if you had a furnished holiday let. Now that won't play into that. If you've made any capital expenditure, you'll only get the tax benefit of that should you sell the property in the future and come in to pay capital gains tax as an individual. So those kind of tax benefits are going to be delayed for those expenses that an individual may be paying.
So when it comes to Airbnb and short-term rentals, let's say you're making Airbnb rental income every single month, and of course that's going to differ every single month. One month it might be 2,000, one month it might be 3,000. How exactly is the tax calculated on that?
For Airbnb, that would fall under general income tax. I think one thing to be aware of on Airbnb is that that is subject to VAT. So most residential lettings are not subject to VAT. But if you have an Airbnb property and your gross income, that's all that before expenses, is over 90k a year, then you will have to start charging VAT on that and completing VAT returns on a quarterly basis.
Okay, so now we get into owning properties through a limited company. Obviously, we've touched upon this here and there. So what are some of the main advantages and disadvantages of owning a property in a limited company from a taxation point of view?
So the main benefit is that if you own a limited company, mortgage interest is a fully allowable expense compared to individual tax where you get a 20% tax credit. There's also that profits in a company, so via corporation tax, are taxed lower than income tax rates. So corporation tax starts at 19%, goes up to 25%, whereas obviously personal tax goes from 20% up to 45%. So there are tax benefits going for a limited company.
The only one thing I would add to that is I think when it comes to one of the disadvantages of a limited company potentially is that when you own a property in your personal name, for some people the income tax might be higher, but for a lot of people, if you fit into the basic 20% tax, it could also be potentially lower. Not only that, even though you might pay less tax in a limited company, the money is still within a limited company.
Yeah.
You still have to then find a way of getting that money out to yourself. Now, whether you do that through dividends or pay yourself a salary or have deductible expenses, we'll get into that. But I think that's something sometimes people don't factor in is they say, well, okay, I'm paying less tax. Yes, but it's not you who's paying less tax, it is your limited company which is paying less tax. You still don't have the money. The money is still sat within some sort of entity. And so then when we talk about capital gains tax and so on and so forth, and how corporation tax is lower than capital gains, yes, but that profit, even after tax, is still in the company.
Yeah.
You then still have to find a way of how do I get that money out to myself.
Yeah, and I think that's the biggest struggle I have with people who own limited companies, not just property ones, but whatever, is that you and a limited company are two separate legal entities. People think that the limited company's money is their money. It's not. It's the limited companies and your separate entities for legal and tax purposes.
So now let's get into the tax implications of limited companies. So now, of course, a limited company pays corporation tax as opposed to paying income tax and capital gains tax and so on and so forth. So put simply, in a limited company, what would happen is you would have your revenue and you would have your cost, whether that is your mortgage interest or whether that is employees who you hire in order to actually manage the properties. What are some of the other things that a limited company can claim as legitimate cost when it comes to running a property business? Whether those are costs for a property itself or whether it's costs for someone who's a director of the company running that company. For example, your phone bills, your laptop, and so on and so forth. What are all of the costs or some of the costs that you can claim both on the property itself and as the running of a company, which goes as an expense?
Yeah. So the main cost that the company can claim is around those kind of big capital expenditure. The company can take the decision to write that off to the P&L income statement should they wish. Whereas if you're an individual, you have to wait until you sell the property to get the tax benefit of those expenses. The other kind of like non-property costs that you can claim for a limited company are those around staff. So if you're paying a salary to yourself as director or to people to manage the property, you can also claim a pension. You can make a pension a deductible expense. So if you are a sole director, you can put money into a pension scheme. It's deductible for corporation tax, and it's a way of you indirectly getting money out of the company into your pension pot. And then you have other things, like if you need equipment as a director, like a laptop, if you want to put your phone bill, as long as the phone bill is in the company's name, you can claim that.
Just to touch on that a bit more, when it comes to claiming a pension as a tax deductible expense. So let's say you have a limited company where you are the director of that limited company and you have a bunch of rental properties which are making you money. And now you want to pay yourself a salary because maybe you now have enough properties whereby you can quit your full-time job and actually rely on the property income. So therefore you set up a monthly payroll for yourself and you're paying yourself a salary. Okay, so now we've gotten that far. How do you now then get onto this part?
As an employer, so the company is technically at that point an employer, they have to provide their employees, which is you as director, with a pension scheme. So you can opt out of that because you are a director, but otherwise you can opt into this and you would have a workplace pension scheme in place. So you as the director, the employee, would make contributions. The minimum is 5% of your salary, but the employer, the minimum they have to pay is 3%. There is no maximum. You can have a really lucrative pension scheme where you contribute 5% and the company contributes 100% of your salary as a pension. But there are arrangements in place where if there is not a workplace pension, a company can make a contribution into a director's personal pension scheme. And helpfully, HMRC gives no guidance on what is a reasonable amount, but they use the term reasonable. So the pension contribution has to reflect the level of work that goes into managing that company.
So in that scenario, let's say you are a director of a limited company and you pay yourself £25,000 a year in terms of salaries. You can then say, well, actually another £25,000, which is 100% of your salary, is a pension contribution.
Exactly.
So if you now have a limited company which only makes £50,000 a year profit, let's say once accounted for all the costs, £20,000 of that, £25,000 of that you pay as a salary, £25,000 you pay as a pension contribution, and then you have a scenario whereby you don't actually have any corporation tax to pay because the company hasn't actually made a profit at the end.
Exactly. And whilst that may feel like a little dubious, like the government is encouraging people to put into pensions, they want employers to have good pension schemes, they want people to contribute into their own pension scheme. It's not like investigated or frowned upon. Because that's kind of government policy. They want you investing in private.
So this seems like one of the policies which I think if someone owns a property in a limited company, I think most people probably overlook that in terms of how much tax you can actually save from that.
Yeah, if you're a director of a company, you're entitled to a pension. And I think not only with property businesses, but just limited companies in general, people do really miss out on pension contributions and set up a workplace pension.
Would you say that's probably one of the biggest ways you can save tax when it comes to limited companies?
Oh, massively. 10 years ago, there were lots of things I could advise an individual on or a company on how to save tax. Things have changed over this last decade, but pensions remain the one biggest thing you've got to save personal tax and also to save company tax. It's the biggest kind of tool you've got to reduce that tax. Whilst it's going into a pension, you will get that money. When you retire, that's money coming to you. So whilst it might feel like you're giving up cash now, it's a future investment. Save corporation tax now and you're going to get that in the future when you retire. And let's be honest, like the state pension, will that be there when we get there? it doesn't feel that secure.
I don't know too much about pensions, and that's a completely different speciality altogether. But now there are some pensions whereby you can get a pension early. You can claim some of your pension allowances early, and so on and so forth. Now, when it comes to contributing to a pension, I guess it's open to which type of pension you contribute into and so on and so on. So there might be cases whereby you can contribute, but also recoup some of that earlier.
Yeah, so I think it's different between each company, but I think each pension provider, but I think if you're like 55, you can get that earlier. It's worth speaking to like a financial advisor or a pension person, because like it's the biggest tool you've got really to save tax.
So now let's say you have a limited company and you have a bunch of properties, and you've, after paying all of the expenses for the properties themselves, so letting agency fees and management fees and maintenance fees and so on and so forth, you've made a profit of £20,000. So like we said, that profit is still within the limited company. What are some of the ways you can get that money out? And so you as a person, as a personal entity, can actually enjoy that money and actually use that money.
Yeah. So I think you've got three key things you can do. So the first one, as mentioned, is a pension scheme. Whilst you won't get the cash right away, that's cash you'll get in the future. The second one is you can have a salary, so you can take a salary from that company. So you have to register for a PAYE scheme with HMRC unless you pay yourself less than £123 per week. But you can withdraw that as a salary, and you can be taxed then at your marginal rate if you have other income. And the third one, which is what most people do, is via dividends. So dividends can be only paid out of post-tax profits. So that's you got your profit, then you deduct your tax, and the amount after that can be withdrawn as a dividend. And dividends generally are taxed at a lower rate than other rates of income tax, particularly if you're a basic rate tax band payer. So if you are a basic rate taxpayer, you will pay 20% on kind of employment income, self-employment income. But if you're a basic rate taxpayer on dividends, you'll pay 8.75%. So there's quite a significant difference there. If you're a higher rate taxpayer, an additional rate taxpayer, you pay tax on dividends at 33.75 and 39.35% on if you're an additional rate taxpayer. So the difference isn't as significant if you're a higher rate or additional rate, but if you're a basic rate taxpayer, the difference between employment income and investment income from dividends is significant. And you also get £500 of dividends tax-free a year, which isn't as good as it used to be. Even if you don't want to take anything, you should at least take the £500 that's available, because that is tax-free and you don't need to declare it.
I think this is another one of those cases that if you have a limited company, one of the tricks sometimes people might miss is that if you have a spouse, especially if the spouse doesn't work, it's very beneficial to add them to your limited company. Because then, once this company has made this profit of, like we say, £20,000, you could pay your spouse a salary of £12,500, which is within your personal allowance, and so therefore there's no tax on that amount. And then the rest you can pay yourself as a dividend. And so the additional £7,500 you pay as a dividend, which is only subject to 8.75% tax. On your £20,000, you've taken £12,500 as your income, which you pay no tax on, and then the additional £7,500 you pay 8.75% tax, which comes to £656.25. So essentially you pay £650 tax on a £20,000 income, which is pretty substantial. That is a lot of money you can pull out of a limited company with barely paying any tax whatsoever, just because you've added someone else into a limited company.
And I've seen all sorts of arrangements where people have, the gran on payroll, or like the mum or the dad. So if you trust someone and you're close to them, like those things are there to be utilised.
So for example, let's say if you have kids who are old enough, so let's say they're 16 plus, and they had a legitimate role in the business, and you can say, well, actually they helped manage the properties, or they helped do X, Y, and Z within the property business, could you then add them as employees of that limited company and therefore pay them a salary and a dividend?
As long as they've got a national insurance number, then they're good to go. I have lots of clients where they have a son or a daughter who is doing an admin role for 12.5 grand a year. So it's, people
plus
do
a dividend.
Yeah, exactly, yeah.
If someone had, let's say, 2 or 3 kids and a spouse, that's 4 people who can make about £20,000 a year by paying £650 in tax per person. That's £80,000 of income, and you're paying about £2,500 in taxation, which is pretty unheard of.
Yeah, definitely. It's worth doing.
The final thing I would add to that as well, in terms of how to get that money out. So in this scenario whereby you've made £20,000, for example, everyone needs a phone, and a phone generally is considered an acceptable taxable expense. So now whether I use my phone for my business and I also use it for my personal use, but in either scenario I need a phone. And so therefore by claiming things which you are going to need in general life anyway, can again reduce that taxation, and it's one way of getting money out, because if your phone contract is £50 a month, well, that's £50 a month which you can put against the company, which is essentially the same as you taking money out of the company. What are some of the common things people can claim in order to get that £20,000 out without paying tax?
So I suppose firstly on the phone, I completely agree. The one thing I would say is that you just make sure you have that account within the company's name and not your own. And then other things, use of home, you can claim a flat rate deduction against the company. You can claim a percentage of utilities for working from home, equivalent to the space and hours that you work. There's also other things, like if you've got a payroll scheme set up, like you can have a company car scheme through the company, which is a way of you getting a car at a kind of discounted rate, and the company would kind of like save tax on that.
So when it comes to setting up and managing a property company, what does that process look like when it comes to not only just incorporation and setting up that company, and second, when it comes to the ongoing reporting, do accounts once a year or every 6 months?
So setting up a company is actually really easy in the UK. And I think the UK continuously is near the top of the league table of the world for setting up a company. So you go to Companies House, it's an online form. I think you pay about £30 now to do it up. And I've seen occasions where people have set up a company and it's incorporated fully live within an hour. I think they work on a basis of 2 days to set up a company, but like I say, it's minutes and hours usually. Once you have a company set up, you can't operate through a personal bank account. The business has to legally have its own bank account. And then in terms of reporting, once a year you'll file your accounts with Companies House. So this is kind of your balance sheet. Primarily people only file their balance sheet at the moment, but there are consultations going on at the moment about whether companies will need to file their income statement on Companies House. And then alongside that, you also have your corporation tax return, which is filed with HMRC. So this is where you declare your profits and how much tax is payable. And more often than not, those are done at the same time. Those usually have to be filed within 9 months of the financial year end. So once you set up a company, you don't tend to end up doing anything from a reporting process for about 2 years. And then the only other thing is you have your confirmation statement, which is replace the old annual return. And this is once a year. You file with Companies House to notify them who the directors are, who the shareholders are, and what you're doing. And they also now have a tick box to confirm that what you're doing is legal. So that should stop any crime.
So I just want to cover some of the additional considerations that if you are going to buy a property within a limited company. Now, the first one being arranging finance. So I think there's a bit of a misconception that some people think, well, if my company is brand new, how would I get bridging finance because my company doesn't have any history? Now, the thing to point out is most people who are buying property in a limited company, it is normally their first company. It's not like a regular business whereby you need 5 years of proven track records before you can go to a lender and say, hey, well, can I now get some money against this business? What happens is when you buy a property, whether it's in your personal name or whether it's in a limited company, generally you as a director will be linked to that company. For example, when I get a bridging loan, which is a short-term finance, a short mortgage, I still have to sign personal guarantees within my personal name as a private entity, as an individual entity. I have never seen or heard of anyone who has issues getting mortgages or finance products in limited companies, as long as their personal circumstances check out. So as long as you have good credit, just like you would do if you were getting a mortgage in your own name, it's exactly the same as a limited company. So you don't have to worry about, well, I don't have any track record, because when you sign up a new limited company, no one has track record. There's nothing you can do to build that track record. The only thing you can do is buy an investment property. And so finance is not an issue. The other thing to consider is that when you do have a limited company and you get finance when it comes to buy-to-let mortgages, those buy-to-let mortgage rates are slightly higher than the rates in your own personal name. Now, pre-2016, a lot of people, or most people, did not used to buy properties in limited companies because, well, the tax rules hadn't changed. Section 24 hadn't come about, and so therefore there wasn't any real benefit in buying a property in a limited company, and so therefore there weren't that many buy-to-let lenders who were willing to give out mortgages to limited companies. Now that has become the norm, and as a result of that, now it's very commonplace for lenders to essentially have buy-to-let mortgages for limited companies. But you still have slightly higher rates in limited companies than you would do in your personal Not that it makes a huge difference, but that is something to consider when you're working out your entire tax regime. Because again, if you're able to claim some expenses and have directors, or for example, if you're having a rent-to-room relief and so on and so forth, it might not always be beneficial for you to have a limited company and pay slightly higher mortgage rates if you're not impacted by any of those things. So that's some additional consideration when it comes to the finance within limited companies. Now, when it comes to extracting the profit within limited companies, I suppose the two main calculations you would have to do is work out, well, one, your corporation tax, because that is how much tax you would pay once you've accounted for all of the costs. And the second is any sort of dividend tax you would have to pay if you are taking money out as dividends once you have paid the corporation tax. So now let's talk about some of the tax planning strategies. What are some of the best way of maximizing deductions and allowances?
With a limited company, the key thing is make sure you're claiming the full allowance for mortgage interest and also those expenses as well as business running expenses. But one thing that people are not always aware of is that losses that you make in a company, those can be carried forward as well as carried back. If you make a loss, what you can do is roll that forward into the next year, which means that next year, should you make a profit, you can deduct the loss you made in the prior year to reduce the profit in that year. And similarly, you can carry that back a year. So last year you made a profit and paid corporation tax, but this year you made a loss. You can roll that back to the last year, adjust last year's profit and get a refund on the corporation tax that you paid. So I think sometimes people get a bit worked up when they make a loss, but a loss is not necessarily a bad thing. And you can utilise that in prior years and the future. So maximising those expenses and sometimes getting a loss is not necessarily a bad thing.
Just to put that into an example, let's say in the last tax year you made a loss of £10,000, right? And in the following year you've now made a profit of £10,000. Would it be as simple as, well, last year you lost £10,000, this year you made £10,000, so when you aggregate the two, you've technically made nothing.
Exactly.
And so therefore, well, there's no profit to pay because you haven't made any money.
Exactly, yeah. So you've made a £10,000 profit this year, but with last year's losses, your actual taxable profit for the year is zero.
Does the timing of the transactions come into play when it comes to property tax? So for example, if you buy a property just before the tax year, just after the tax year, does that impact your taxation in any way?
Not particularly. The only time I would say it would impact it is that if you're going to sell a property and corporation tax in the next year is significantly going up, that's the only real time it's going to impact your tax. But generally, no real issue, to be honest.
I suppose you could have a scenario whereby, especially when it comes to corporation tax, because it is tiered. So for example, it's 19% if your profits are under £50,000, and it slightly increases with the marginal rate if your profits are more than £50,000. So what you could do is, if you're selling multiple properties, you could sell one in the first tax year and sell second in the second tax year in order to keep your profits slightly low. Now, as opposed to selling both at the same time, having very high profits in the same tax year, and therefore paying a much higher rate than the 19%. So you could do it in that scenario. I suppose when it comes to properties in your personal name, it wouldn't really matter as much.
Exactly,
because you would pay capital gains tax on properties as of when you sell them. So there wouldn't be anything to sort of move around in order to get the timing right. But I guess with limited companies, there could be. And especially like you mentioned, because you can offset some of your previous losses, maybe because you've had a big loss in the previous year, you can say, well, actually, if I strategically sell my property the following year, I won't have any corporation tax to pay whatsoever. Whereas if I left it a couple of years, it comes back in. In terms of going back, how many years can you go back when it comes to these losses?
I believe it's just a year at the moment. Just on your point as well about the kind of like forward thinking, I think this really comes back to that point of, you need to be proactive about taxes. Like if you're reactive, you're not going to utilise these things that are in place. So if you're proactive and know you're going to sell multiple items, and it's worth then speaking to your accountant and doing a bit of modelling to work out like what the tax benefit is. So I think it's thinking forward's quite positive.
Because all of my properties are within a limited company, and now when we had some of the COVID years, the company did make a loss because we still had mortgages to pay, but we didn't have as many tenants as previous years because people were moving, and a lot of the tenants we get in London are people from other countries and they weren't coming to London. And so we did actually have a tax loss. But in the following year, which is this year, I ended up selling one of my properties in Brixton for £400,000. And again, normally you would then just pay your corporation tax on the profits you've made. But because I've had a loss in the last tax year, as a result of that, I don't have to pay any corporation tax because that loss is essentially offset. So that's one example of selling the property at the right time in order to make sure you reduce that tax as much as possible. So then we get into compliance and record keeping. Now, what are some of the key considerations when it comes to the HMRC reporting on property tax?
When you file your taxes with HMRC, be it company or individual, you only put the numbers in. You don't give them any proof. But technically, HMRC at any point can ask for proof and breakdowns of all the income and expenses you've got. So you need to make sure you not only keep an accurate record of your income and expenses, but also proof. But luckily, it's easier nowadays when most things are done online and you can have online receipts for stuff. But if you're going out and buying something where you've got a hard receipt, you need to save that, whether that's a picture of that or physically. You need to make sure you've got sufficient accounting records, should HMRC ever ask. And the chances are they never will, but there is always a chance that they can and they will ask for proof.
What are some of the best ways of essentially keeping all of these records? Obviously, in the digital world, everything is online, but what are some of the ways of easing that?
So it kind of ranges really. So I have some clients who will just WhatsApp me a picture of every receipt they send. So that completely ruins my photo feed on my phone, but it is a way of storing it electronically. But there are also really good software providers like Dext, where you can store all of your invoices, all of your receipts on there. QuickBooks and Xero are accounting software companies, like the two main ones. They do have add-ins where you can sync through pictures of expenses with the transaction on the bank account. I think the main consideration is just finding something that works for you. Stuff like Dex and that, they're amazing, but I personally would never get on board with those. I just can't. That's not how my mind works. But for me, I take a picture of my receipts, then I save it on an album. You just got to find something that works for you and make sure you enact it when you have that.
When you own a property in your personal name, you end up doing an end-of-year tax return. What are some of the common mistakes people make when it comes to doing the tax return, which could end up being quite costly?
The first biggest mistake is that people don't declare, and I think historically people who have Airbnb haven't, and Airbnb and other providers are now sharing data with HMRC. And so if you've not been declaring for years, HMRC now knows and will find you. And I've had so many clients who have now filed tax returns because they've been prompted by HMRC because Airbnb shared this information. So I think the first biggest mistake is that people don't declare. And if you don't declare, HMRC will issue penalties at you. They'll issue fines. Those only increase in value and they get more extreme depending on how your attitude is to working with HMRC. Be proactive, get ahead of it, declare your tax. The other biggest mistake is that people put mortgage interest in the wrong box. As we've discussed, mortgage interest, you only get 20% of that as a tax credit, not a full deduction. But some people will put that in the box that is for fully allowable expenses. And it then means that their taxable profit is different, and it means that they're doing it incorrectly. It's there to take as a tax credit, not as mortgage interest. I suppose like if you are doing your tax return on Government Gateway, where there are separate boxes to input the information for that feed through into your tax return, just make sure that you're putting your mortgage interest within the financial costs as opposed to allowable costs. Other kind of key issue is that people will try and claim capital expenses when they should be claimed when you sell the property as an individual. In year, when you're doing your income tax, you should only be claiming those kind of like revenue expenses, those kind of things that maintain a property, not enhance a property. The other kind of biggest mistake and pitfall is that, as we've discussed, where spouses want to change the split of income and how that's declared, people think that they can just agree that between themselves and assume that they'll do that percentage. That's completely inaccurate. You need to have not only a declaration of trust from a solicitor, but you also need to send that to HMRC and get Form 17 signed. If you have neither of those, then HMRC can reverse the split you've done and make you both pay for that in the 50-50 split.
Just to touch on that a bit further, let's say someone has a parent who is now retired, doesn't have any sort of income. Would that be seen as a legitimate thing that they are the ones claiming the income, or does it have to be a spouse, a civil partnership or something along those lines?
So it doesn't have to just be your spouse, it could be anyone else. A parent probably feels more reasonable to HMRC than like a random
friend. Yeah.
And as long as you've got that legal agreement in place, like you're legally giving up your right to that income and they're legally accepting the right of the obligation of that income, then it should be okay. But the key is just getting the legal document in place and HMRC approval. Without those, it's irrelevant. Final biggest mistake, which we've kind of touched upon, is just not keeping accurate records, not keeping complete records, not keeping any records. Like I've had clients come to me who surprisingly have income and expenses that are all round numbers and no proof of those.
Right.
You know, you need to have complete records, because not only will your accountant ask for them, but HMRC could ask for them. And if it looks like you've given incorrect information, HMRC comes down on that quite heavily.
Now, let's say you buy an investment property, but you live abroad. What are the tax implications if you're not a UK resident?
The first one is that if you're a non-UK resident with a UK property, then you will need to sign up for the non-resident landlord scheme with HMRC. Other considerations are that whilst you may not be a UK tax resident, you will need to declare that UK tax income to HMRC. They get primary dibs on that as opposed to the country that you are a resident in. So whilst you might not think you are a tax resident in the UK, you still have tax reporting obligations. And then the final one, I suppose, is that if you are a non-UK tax resident, you may not be entitled to get a personal allowance of £12,500 tax-free income, like all UK citizens do. It varies between countries, so make sure you check that too, because even if you've made £100 of profit and you've got no personal allowance, you're going to have to pay tax on that. So it's worth checking that.
I think we touched upon this earlier, but is there like a standard rate, or do you know how that rate works in terms of what tax you would pay?
Yeah.
So let's say someone makes £10,000 in terms of rental income. Just like all other UK residents, I guess the mortgage interest they can only claim 20% of.
Exactly, yeah.
So they're in the same boat as everyone else. But after you've accounted for mortgage interest and everything else, let's say you've genuinely made about £5,000, which is your taxable income. Where does that go into? Do you just pay a flat rate? Do you pay the basic rate? How does that work?
So it's the same tax rates as the UK citizens. If you've made £5,000, then you'll pay the basic rate, 20%.
But the only difference being that you might not be able to get the personal allowance.
Exactly, yeah. You've got two instances there where if you made £5,000 profit, that's either wiped out by the personal allowance that you'll get, or if you're not getting a personal allowance, then you're going to pay 20% on that, which is £1,000 of tax.
Whether it's the Conservative government who comes in or a Labour government comes in, we don't know what the policies are going to be. Are there any things you can do to try to future-proof yourself as much as possible? So if you were advising someone and you were saying this is how you should set yourself up, not necessarily for the perfect outcome, but for the outcome which is least likely to impact you in the long run, do you have any advice on that?
It's not a one and done consideration. Just when you set up and whatever arrangements you go into, that might be right on day one, but 2 years down the line, that might not be correct. Once a year, reflecting on what are you doing and is that the right thing? You've got to be proactive about this. Like if you want to make money on this, it's pointless being reactive and backwards looking. You need to be like forward looking and like speaking with your accountant and keeping up to date on changes. If you're not having those thoughts, or that you're not having like those discussions with your accountant or like other professionals, then you're kind of not future-proofing yourself.
One of the things I think people could do in order to try to future-proof themselves as much as possible is that even if, for example, right now it might not make sense to buy a property in a limited company for you individually because maybe you're financially better off buying a property in your personal name, I do think the way some of the policies lined up, they're set up to impact the individual landlord who is not within a limited company, whereas to change the laws within a limited company, they generally seem to be a bit harder, because my personal belief is if you change the rules within limited companies, it then impacts all businesses as opposed to a small business with 2 or 3 properties. Whereas if you are a small landlord with 2 or 3 properties, it's very easy to target those individual landlords by having new policies come into play. But if you have a property in a limited company, for a government to say, well, actually, the finance cost is no longer deductible, well, that then has implications and ramifications for all businesses within the UK who have finance as a cost. I think it's much harder for the government to change policies when it comes to limited companies than it does for you as a person. And the other thing you have to then consider is that if down the line you do have a large property portfolio, maybe you have 5 properties, maybe you have 10 properties, well, if you own that property within a limited company, yes, you could sign a bunch of forms and you can say, well, I'll give some of my income to my kids and some to my mother and spouse and so on and so forth. If you had a limited company where you could then add them as legitimate employees who had legitimate roles, it would be much, much easier for you to take money out of that limited company through expenses, through dividends, through personal allowances, and so on and so forth. And again, those rules seem to be slightly harder to change as compared to some things which impact you from a personal point of view. There's 2 things to consider here. You can take a shorter term approach and you can say, well, actually, as of right now, I'm better off in a personal name because of the fact that I'm a basic rate taxpayer or I'm below the personal allowance limit. But I think if I had to pick a safer option, and of course this is a personal preference, there is no guarantee that this is going to work, because anything can change, and taxes can change, and regulations can change. But my personal money would be on, it's probably safer to be in a limited company where you and the giants in this industry are all within the same boat, as opposed to you as an individual, you've got a couple of properties and suddenly something changes and now those properties don't make any money whatsoever. Those are my thoughts in terms of safeguarding.
Picking up on your point about it's easier to target a landlord than it is to target a specific group of limited companies. I think it's a really good point, because the whole UK economy is based on finance and people lending money. If you change for limited companies, the mortgage interest or loan interest going from fully amount of deduction to just 20% credit, there'd be uproar. I think it's a really key point, that. But I think the other one is, as well, is like in a limited company, if you're a shareholder, your liability is limited to the number of shares that you have. If you have properties in your name, your liability is kind of unlimited. You have those legal protections as well for a limited company. So yeah, I would agree with you.
Then the final thing, in terms of staying informed now, things are always changing, new rules are always coming into play. What is the best way for someone to keep informed in terms of what is changing, and what is the best way of actually being proactive?
I think it's a tough one, this, because I think there's so many rules and regulations, but who's actually informing you about these? I think it's quite a tough thing to keep on top of. So I think firstly, if you've got an accountant, speak with an accountant. If you don't have an accountant, go and speak with one. They legally have to keep up to date with what's going on, so speak to an accountant. But I think there's also things like this YouTube video. There's online blogs. I think it's actively searching out that information, because no one is going to tell you it. Like, you need to go and find that. I understand that HMRC has a series of webinars as well around, if you're like a landlord, stuff around income tax, stuff like that's worth having a look at. But you're going to have to be proactive about it, because no one is going to tell you this. So.
Perfect. Well, thank you very much. That's been very, very useful, and I hope people watching this have got a lot of value from it, not just in terms of ways of saving tax, but a lot of things that they might not have potentially considered before in terms of regulation and so on and so forth. So thank you for doing this, and I think a lot of people have probably found this very, very useful.
Good stuff. Thank you.
Perfect.
If you want to implement any of these strategies, get in touch with TaxScouts, and right now you can get 10% off as a new user by clicking the link in the description below.